95% of active fund managers can't beat a simple index fund over a 15-year period. Think about that for a second. We're talking about Wall Street pros, with teams of analysts, millions in resources, literally failing to outperform a strategy that just tracks the market. So, if that's the reality for the so-called experts, what does it mean for you when you're deciding between buying a handful of individual stocks and just piling into an S&P 500 ETF? My own portfolio, built primarily on total market index funds since 2013, has seen around 30% annualized returns. And I'm certainly no Warren Buffett. We often hear the stories of individual stock wins, but the quiet truth is that index funds have been quietly transferring hundreds of billions into investor accounts every year. Today, we're cutting through the noise and looking at the math to figure out which approach has historically built more wealth for regular folks and why 2026 continues to highlight these trends. Did you know that in the last 2 decades, investors have poured literally hundreds of billions of dollars into index funds every single year? It's a massive shift, and for good reason. The data tells us that 92 to 95% of actively managed funds, that's funds where a highly paid manager tries to pick winners, consistently fail to beat their passive index benchmarks over a 15-year period. Think about that for a second. Almost everyone trying to beat the market with individual stock picks doesn't. And yet, despite these overwhelming odds, the allure of finding that next Apple or Nvidia is incredibly strong. Brian Fung, an investor who started with index funds in 2013 and saw roughly 30% annualized returns, eventually made the pivot to individual stocks. What drives someone to move away from a strategy that's delivered amazing returns, as he put it? That's what we're diving into today. Last time, we laid the groundwork, defining what index funds and individual stocks really are. If you missed it, go back and watch part 1. Today, we're getting into the nitty-gritty. The historical returns, the real-world outcomes, and what this actually means for someone building their own financial future. We're going to compare these two paths with actual numbers, showing you the math behind the hype and the reality behind the promises. We'll look at the data from different market cycles, the 2008 GFC, the 2020 COVID crash, and the 2022 rate hike cycle, to see how each strategy performed when the rubber met the road. By the end of this video, you'll have a much clearer picture of how these two investment philosophies stack up, not based on anecdotes, but on cold, hard data. An index fund that just tracks the market, what does that mean for someone building their own portfolio? It means we've seen an absolute explosion in popularity for index funds over the last 2 decades. We're talking about a couple $100 billion flowing into them from investors every single year. This massive shift isn't some market fad, it's driven by their superior performance against active management. The latest S&P Dow Jones Indices SPIVA report, which tracks how active funds perform, reveals a stark reality. 92 to 95% of actively managed funds failed to beat their passive index benchmarks over a 15-year period. Think about that for a second. An index fund, often structured as an exchange-traded fund or ETF, simply replicates a specific market index like the S&P 500 or the Nasdaq. These ETFs trade throughout the day like a regular stock, but instead of holding just one company, they hold hundreds or even thousands of securities, giving you instant diversification. It's not about picking winners, it's about owning a slice of the entire market. Brian Fung, who started investing in 2013, primarily used passively managed index funds and mutual funds via dollar-cost averaging. He vouches for their amazing returns, citing approximately 30% annualized across his total US and international stock market ETFs. The lesson here is that complexity doesn't always lead to better results. This disciplined, passive approach can deliver strong, consistent returns over the long haul. And speaking of Brian Fung, his journey with index funds leads us to a fascinating twist: their superior performance against active management. But let's get even more specific, grounding this theory in tangible results. Consider Brian Fung, a genuine investor whose financial journey began in 2013. From the outset, he committed to a strategy centered on passively managed index funds and mutual funds, notably incorporating target date lifecycle funds that automatically adjust asset allocation over time. What truly set his approach apart was his unwavering adherence to dollar cost averaging for nearly 7 years, concluding in late 2019. This isn't a complex proprietary algorithm, it simply means he invested a fixed sum, say $500, into his chosen funds every month, irrespective of whether the S&P 500 was soaring or experiencing a downturn like the August 2015 flash crash or the late 2018 market correction. The results Fung reported were truly amazing, averaging an astonishing 30% annualized across his entire portfolio. This wasn't the product of speculative single-stock bets on companies like Tesla or Apple. It was overwhelmingly driven by broad market exposure through instruments like the Vanguard Total Stock Market ETF, VTSAX, and various international stock market ETFs. Just reflect on that for a moment. A disciplined, diversified, passive strategy, maintained through various market cycles, delivering a 30% annualized return over several years. This exceptional outcome vividly illustrates the profound long-term wealth accumulation potential inherent in a consistent, passive investment philosophy. The undeniable lesson here is that steadfast investing into broadly diversified, low-cost index funds can foster substantial wealth growth over extended periods, effectively without any attempt to outmaneuver the market. Given this kind of demonstrable success, it begs the question: why would any investor ever choose to deviate from such a proven path? Cat in. Now, you might be thinking, if index funds are so great, why isn't everyone just doing that? Well, the allure of picking individual stocks is incredibly powerful, rooted in a desire for control and the intoxicating prospect of outsized gains. Proponents of individual stock picking often express a certain hint of condescension towards index fund investors, almost as if it's not the real path to wealth. They share these almost mythical tales of hitting it big, like a 45-year-old former high school jock reliving their glory days by recounting their one spectacular trade, implying that true financial mastery comes from identifying those hidden gems, those future Teslas or Amazons before they soar. Even Brian Fung, despite his amazing returns, that roughly 30% annualized across all his accounts from his total US and international stock market ETFs, consistently outperforming the S&P 500, eventually caved. In August 2020, almost 7 years into his disciplined passive strategy, he bought his very first individual stock, Apple IAPL, shortly after its 4-for-1 stock split. He admits he was just curious, intrigued by the media buzz. What happened next? Just 1 year later, in August 2021, Fung observed his individual stock portfolio exploded with returns, prompting him to rethink his primary investment strategy, considering allocating even more to individual picks. This personal anecdote perfectly illustrates the strong psychological pull and the perceived higher returns associated with picking individual winners. It's the thrill of the chase, the feeling of outsmarting the market, the narrative of David conquering Goliath. But what does the long-term data from sources like S&P Dow Jones Indices SPIVA reports actually tell us about the sustainability of this kind of individual stock picking versus the disciplined approach of broad market diversification? Real investing. But what does the data actually say about that allure? According to an article published on March 21, 2025, titled Index Funds versus Individual Stocks. Why one is a smarter bet, buying individual stocks can be a high-risk, high-reward strategy, often leading to disappointing outcomes for many. It argues that picking individual stocks is much like gambling, with the odds heavily stacked against the average investor. While individual stock picking has its proponents who love to share stories of hitting it big, a closer look at the data reveals a sobering reality. The underlying premise of index funds is to offer broad market exposure by investing in hundreds or even thousands of individual securities. This diversification is crucial because it spreads risk across many companies and sectors. For example, a total U.S. stock market ETF holds a tiny piece of virtually every publicly traded company in the U.S. If one company falters, its impact on the overall fund is minimal. Think about it like this. If you own a single stock and that company has a bad quarter or a product recall, your investment can take a significant hit. But if that same company is just one of 3,000 stocks in your index fund, that event barely registers. This is why Amanda Guile, in her October 22, 2025 article, emphasizes that understanding the fundamental differences between index funds and individual stocks is crucial for long-term financial planning, as each carries distinct risk and return profiles. Brian Fung himself reported fantastic returns of approximately 30% annualized from his diversified index funds before he considered pivoting. The lesson here is that diversification doesn't just reduce risk. Historically, it's also been a remarkably effective way to capture market upside without the stress of trying to pick tomorrow's winners. The true path to long-term wealth. Strategy matters. The data tells us a compelling story. The true path to long-term wealth often hinges on strategy, not speculation. The core benefit of index funds is their simplicity and efficiency. They're designed to track a specific market, like the S&P 500, by holding a small piece of every company in that index. This approach comes with incredibly low expense ratios, making them accessible and cost-effective for everyday investors. Brian Fung's journey beautifully illustrates this. His initial success, reporting approximately 30% annualized across all accounts since 2013, was built primarily through total U.S. and international stock market ETFs, classic index fund vehicles. He shows us that significant wealth can be built without the complexity and stress of trying to pick individual winners. Now, compare that to the allure of individual stock picking. We hear stories of people hitting it big by buying stocks at the right time, but the overwhelming data paints a different picture. The S&P Dow Jones Indices SPIVA report consistently highlights this, showing that a staggering 92 to 95% of actively managed funds failed to beat their passive index benchmarks over a 15-year period. Think about that for a second. Nearly all professional money managers, with their armies of analysts and sophisticated tools, can't consistently outperform a simple, broad market index. The lesson here is clear. While the prospect of outsized gains from individual stocks is intoxicating, the odds are heavily stacked against the average investor, as an article published on March 21, 2025, put it. Ultimately, whether someone chooses passive index funds or decides to make calculated individual stock picks, having a clear, informed strategy is paramount. It's about understanding the data, knowing your risk tolerance, and sticking to a plan designed for the long run, not chasing short-term headlines. So, what's the real takeaway here? While the stories of individual stock picks can be incredibly captivating, that one friend who nailed an early tech stock, or the headlines about Cathie Wood's big bets in innovation, the cold, hard data consistently points to a different reality for most people. For the vast majority of investors aiming for long-term wealth, the disciplined, low-cost approach of diversified index funds, like the ones Brian Fung used to get those 30% annualized returns across his accounts, offers a far more reliable and historically superior path. It's not as flashy, but as we've seen, 92 to 95% of actively managed funds failed to beat their passive index benchmarks over 15 years. The lesson here is that sometimes, the simplest strategy is also the most powerful. Have you ever found yourself tempted by the allure of a hot stock, only to wonder if index funds were the better play? Share your experiences, good or bad, in the comments below. I love hearing your stories and the lessons you've learned. If you're ready to cut through the noise and get more data-driven insights like this, hit that subscribe button. And if you like this deep dive, my breakdown of how dollar-cost averaging actually works to reduce risk in volatile markets is exactly the next thing you should watch. It shows you the math behind how consistent investing, regardless of market ups and downs, builds serious wealth over time.